Hi everybody and welcome back to the series on property, plant and equipment. Just a quick recap. In part 1 we went through basic to advanced formula on depreciation and wear and tear. In part 2 we reread parts of the question and split the information into 3 coherent timelines. So we had your new plant as well as the sale of plant and existing plant. In this video, we are going to reread the question in its entirety and emphasize on the salient points. The following information relates to ABC Limited, a company that produces wooden roof trusses. Plant. All plant was purchased on 1 Jan 04 for 500,000 rands. The depreciation policy, which has remained unchanged since its acquisition, is the straight-line method over 5 years. This plant is estimated to have a nil residual value at the end of its expected useful life. So bullet number 1 talks about your existing plant. The company intends to keep the plant and has adopted the revaluation model, accounting for the revaluation on the net replacement value basis. The maximum amount is transferred from the revaluation surplus account to the retained earnings account on an annual basis. So the second bullet over here is what actually elevates the question and makes it super hot. Two key things to remember is they're telling you the valuation model as well as how you will treat your reval surplus. Plant was revalued by iSmart, an independent sworn appraiser and member of the Institute of Values. So bullet number 3 basically gives you info that you're going to copy and paste verbatim into your PPE disclosure note. On 1 July 06, plant with a book value of 140,000, tax value 75, was disposed of at a profit of 50 and replaced by the same day. This replacement is estimated to have a residual value of 20,000. So this fourth bullet talks about your plant that you acquired as well as plant that you sold. So if you notice the blue boxes being bullet number 1 and bullet number 4 give you the 3 key transactions that underpins this entire question. SARS grants a tax allowance on plant of 25% per annum on the straight line basis, a portion from the date it was brought into use. The normal tax rate is 30%, 35% in 2005 and 2004. There are no permanent or temporary differences other than those that are evident from the above information. And the last point points to the fact that there is a change in tax rate. So you maybe want to just take a moment and just pause this video, reread the question and reread these facts, because as we go through other videos in the series, we are going to go through the requirements and we're going to tackle each of the requirements. Now, just by reading this fact pattern, it's a given that the question is going to ask you for some sort of deferred tax balance sheet workings. It's going to possibly ask you for a deferred tax note, for a tax expense note, as well as a PPE note. Videos that will follow will then cover each of these requirements and tackle it in bite-sized portions. If you like this video, and if you found it useful, please share it with others, click like and subscribe.